The flow of capital into the reinsurance sector has altered the way reinsurance solutions are structured. We asked Arch Capital Chairman, President and CEO Dinos Iordanou about trends in capital strategies and the impact of regulation on major insurance domiciles during the IIS Global Insurance Forum in New York. Here are the highlights.
Is regulation abating or is becoming more burdensome? Well, even though the concept is a positive concept that one jurisdiction will recognize another jurisdiction's regulatory schemes, I believe so far we have not seen the application of that in practice. So in essence today, even though this I've considered a positive step, the application is that we have dual regulation. Local jurisdictions, they will regulate under their own rules, independent of the endorsement of the European Union of different jurisdictions about their regulatory regime. So hopefully in the future, as supervisory colleges start trusting each other, we might create a more efficient system and eliminate cost out of the regulatory burden. But for the time being, I would have to say that the burden is escalating, not de-escalating. The influx of capital has affected, in my view, the cost of insurance. In essence, excess supply of capital has reduced pricing and, in essence, margin. It has not yet shown in the financial reported numbers, but pure economic thinking, more capital chasing the same amount of revenue, it will cause prices to go down, and I think that's what we've seen. The excess capital has caused. It's good for the consumer at the end of the day because it's providing a cheaper product. I'm not so good, it's healthy for the industry. I don't think it's a new mindset. I think capital is always looking for returns. Even though the returns, they're under pressure in the insurance business, they're still reasonably good returns compared to what else investors have available them. Interest rates, they're in a very, very low area, unprecedented, in my 40 years in the business that we had 5 years of almost zero interest rates. So for that reason, I think capital is looking in other places, and insurance, it's a place that is still producing high single-digit returns on that capital. So, for that reason, I think that's why you're seeing, capital entering the business. Having said that, capital always is looking for adequate return. So on a risk-adjusted basis, because the insurance business is a risky business, I'm not so sure it's a better place than other places. But for the time being, it looks like it's in a better place. Once we have one or two major cats, then we will see if those returns, they're adequate, for those that chose to participate in that sector. Convergence usually is positive on the basis that consolidation within the business creates larger, more professional organizations, eliminates duplication of effort and excess cost. So at the end of the day, the buyer of the products, benefits from it. During the convergence, it creates, though, some turmoil that it might be destructive to some and opportunistic to others. For us, we are looking to see if there is any opportunities for our company based on the consolidation effort that the industry is going through right now. For us, the emphasis is on our primary insurance operations, which we believe we're still getting adequate rates, especially on the small and medium-sized accounts. So our SME business, independent if it's in the US or internationally, is something that we like to grow. And also, we have high expectations in the mortgage insurance space, a new area of insurance exposure for Arch that we have embarked upon with the acquisition of CMG and the acquisition of the assets of PMI. That business, even though it's new to us, is in a good place. The market is attractive, and we believe it will be a growth area for Arch for many years to come.
For more of our coverage of the Global Insurance Forum from New York, visit the RIN TV On Demand Library.